midst of revising the paper right now, and so we really do appreciate any feedback. And in fact, during the talk, I'll mention some of the things we're working on right now. Now, this paper is about active short selling. And so what do we mean by that? Well, traditionally, we think about short sellers as oftentimes being quite secretive. There's no disclosure requirements in the US for when it comes to short positions. And so in this paper, we're going to be studying strategic communication via disclosure of short positions. That is, we're going to be looking at investors who willingly talk about their short positions and engage in communication with other investors. Now, the reason, or one of the reasons, why we traditionally think about short sellers as being somewhat secretive is the fact that there's many instances throughout history in which short sellers have been vilified. And so you can go all the way back to the 17th century in the Dutch East India Company. There was a former director of the firm that was short selling the stock, spreading false rumors, and eventually was exiled from the Netherlands. And then you can look at instances in the US, Black Tuesday in 1929, Black Monday in 1987, and most recently during the financial crisis. In all of these episodes, we saw short sellers being blamed, at least in part, by policymakers, the media, and the public in general for what was going on. Indeed, during the financial crisis, Andrew Cuomo, who at the time was the Attorney General of New York, likened short sellers to looters after a hurricane. Owen Lamont, in a paper from 2012, talked about how short sellers are characterized as inhuman, un-American, and against God. And the famous short seller Jim Chanos used slightly more colorful language, saying that people think I have two horns and spread syphilis. And indeed, we see anecdotal evidence that the disclosure of short positions can entail significant costs. So for example, the hedge fund SAC was sued for libel in 2006, and those accusations were stemming from a short selling campaign. Bill Ackman was even investigated by the FBI for a short position in 2015. And in general, managers can take all sorts of anti-shorting actions to potentially harm short sellers. This is something that Lamont talks about in the paper I just mentioned. Managers can do things like trying to initiate a short squeeze in order to hurt short sellers. And in fact, Jones, Reed, and Waller in a paper from 2016 find evidence consistent with this general idea that disclosure of short positions is costly. They find that once disclosure was mandated for some short positions starting in 2016, this led to an overall drop in short selling. Now, despite all of this, and the reason why we initially started thinking about this project was because there's anecdotal evidence that, well, despite short selling being costly, we're seeing more and more short sellers come out and discuss their positions. And so in recent years, there's been a number of these high-profile short selling campaigns, oftentimes initiated by hedge funds. And so this is what we want to think about in this paper. We're going to be analyzing the voluntary disclosure of short positions by hedge funds. In a few slides, I'll talk more about sort of the specific questions that we're going to be asking in this paper. But before we get there, let's just walk through an example of one of these campaigns. And so this is David Einhorn against Allied Capital. Allied Capital is a mezzanine financing firm that's publicly traded. And so in May of 2002, David Einhorn was at the Sohn Investment Conference. And so this is an investment conference where a bunch of big fund managers come and they pitch their best idea. It's a way to raise money for charity. And so during this conference, Einhorn announced that he had a short position in Allied. And he specifically accused the firm of using different types of accounting accounting gimmicks in order to boost profitability and hide loan losses. And so the market reacted to this announcement with shares dropping by over 10% the following day. Now, about a month after Einhorn gave this speech at the Sohn conference, the SEC began an investigation. Specifically, the SEC began to investigate Einhorn and whether or not he engaged in any sort of market manipulation. Now, this didn't really get anywhere, but 2 years later, the SEC also started to investigate Allied, specifically focusing on the accusations made by Einhorn and other short sellers. In 2007, Allied settled with the SEC. They did not pay a financial penalty, though they did agree to change some of their accounting practices. And this story ends in 2010. Allied was acquired following the financial crisis, 90% below its peak value. Now, Einhorn actually ended up writing a whole book about his experience with Allied Capital. This story gets really weird, in fact, where he accused Allied of hiring private eyes to follow him around and tapping his phones. But in the book, Einhorn states that most short sellers remain anonymous, and after seeing what I have gone through for simply calling a spade, who could blame them? All right, so in this paper, we're studying again this idea of active short selling as a form of strategic communication. And so specifically, if you're familiar with the literature on strategic communication, there's generally speaking two key ingredients to these models. First is the reputation of the sender. That is this sender known for providing reliable information? And second is the credibility of the message itself. And so something that we're going to come back to when we talk about the mechanism in this paper is, well, are our findings consistent with these models of strategic communication? Now, another important idea and why we're analyzing short selling campaigns in this paper is that there's an important difference between the disclosure of positive and negative information. And so there's a lot of literature arguing that, all right, well, if an investor has positive information, they have an idea that managers can implement that will cause the stock price to go up. Well, oftentimes that information is communicated privately to managers. And so this is the idea of there's behind the scenes interventions. But think about what happens if an investor has negative information. For instance, suppose an investor knows or a short seller knows that a firm is engaging in fraud. Well, if that's the case, there's no incentive to privately communicate with managers. Why is that? Well, if you're short a stock, you don't want to privately communicate with the CEO of the firm because that would give the CEO a chance to potentially fix whatever is wrong. That is to stop engaging in the fraud and thus not giving you a chance to profit off of this information. And so there's this important asymmetry going on here when it comes to communicating positive versus negative information. Now, why are we looking at hedge funds? Well, I think hedge funds are an interesting laboratory to analyze this notion of strategic communication, in that it's not necessarily clear how frequently we would expect hedge funds to engage in active short selling. And so on the positive side, well, hedge funds don't really have any sort of restrictions that would bar them from shorting a stock or buying put options. And indeed, many hedge funds, in particular activist hedge funds, often adopt hostile tactics. And so it's possible that, well, maybe some of the costs associated with public disclosure of a short position might be lower for these investors. Now, on the flip side, hedge funds we oftentimes think about as valuing privacy. We usually don't see hedge funds making disclosures when they're not required to. And they're certainly not required under the regulatory regime in the US to disclose any of their short positions. And on top of this, well, hedge funds might be in a better position than other types of investors to deal with some of the risks associated with short selling. And so, for instance, hedge funds often have contractual provisions with their limited partners, things like lockup periods that might help to mitigate some risks. And there's also important differences between hedge funds and other investors that other papers look at when it comes to disclosure of short positions. And so in particular, other papers look at small arbitrageurs, things like these firms Muddy Waters. And so these are small research firms that publish reports, oftentimes with negative information about a stock. And so this paper by Alexander Lundquist argues that, well, the presence of these investors helps to overcome limits to arbitrage. And so this is something that an argument that we're specifically going to be considering later on in the paper. And we argue that this idea of limits to arbitrage probably isn't the primary explanation for what we're seeing when it comes to hedge funds. All right, so let me briefly walk you through our main findings here. So first, we undertake just sort of a basic analysis of what's going on with these campaigns. How common is active short selling by hedge funds? And so we see that since 2008, there's about 30 of these campaigns per year. And this has increased over time. Prior to 2008, we generally see 10 or fewer campaigns per year. And one of the striking things that we'll be thinking about in this paper is the fact that these campaigns are almost entirely undertaken by activist hedge funds. Specifically, about 80% of the campaigns are undertaken by activists. Less than 20% are undertaken by hedge funds that aren't activists. And the typical allegations in these campaigns relate to things like valuation, where the hedge fund will just come out and say, we think this stock is overvalued, fraud, the firm's business model, and so on. Next, we analyze what are the effects of campaigns on firm value, as well as the behavior of other stakeholders. That is, if we go back to thinking about this idea of strategic communication, well, to the extent that the signal sent by the hedge fund contains valuable information, we would expect this both to be reflected in the stock price, as well as potentially in the behavior of other stakeholders. We find evidence consistent with this idea. CARs are around -7% around the announcement of a short selling campaign. And we also see that other stakeholders, namely other short sellers, as well as litigants, respond to this. Specifically, we see an increase in total short interest following a campaign, as well as a higher likelihood that firms face lawsuits. And finally, we think about the mechanism. Specifically, we think about what is the role of reputation and credibility in this type of strategic communication. And overall, we find evidence that's consistent with these general models. Specifically, we find that experienced hedge funds and hedge funds that use hostile tactics and engage in shareholder activism are more likely to undertake these campaigns, which we argue is measure a proxy for reputation. And then we also find evidence consistent with this idea that the credibility of the message matters. Specifically, our main findings are driven by instances in which the hedge fund makes a specific allegation related to the firm. That is, we don't see strong effects for when a hedge fund makes a general claim of overvaluation and says that they're short a stock. We do see strong effects when a hedge fund makes an allegation like the firm is engaging in fraud. All right, so just to briefly sort of place this paper in the literature, we think that this paper is building on, as I mentioned, some of these studies of strategic communication. We'll argue that our findings are consistent with the idea that investor reputation and credibility play a key role in this form of communication. And we think that this also highlights this important difference between strategic communication of positive and negative information, as I noted before. We also contribute to the broad literature on short selling. The bulk of this literature looks at things like aggregate short interest. And here we're going to be arguing that, well, the strategic communication by short sellers can also play an important role in enhancing the flow of negative information into prices. As I mentioned before, there's other recent papers looking at disclosure of short positions by different types of investors. And we think that our focus on investor reputation and credibility contributes to this line of literature. And then finally, we contribute to this broad literature looking at activist hedge funds. And specifically, our findings highlight the idea that activism experience also plays a key role in what we're observing with short selling. Specifically, activism experience enhances strategic communication for reasons we'll get into later on in the paper. All right, so next I'm going to talk about the data that we're using in this paper. So we're going to be focusing on short campaigns by, we start out with an initial list of 1,200 hedge funds between 1996 and 2015. We're actually in the process now of having some RAs help us to update this data through 2019. Now, importantly, disclosure of short positions is not required in the US. And so we're going to use mostly Factiva as well as Google searches to search for the disclosure of these campaigns in newspapers, blogs, TV transcripts, etc. And then we go ahead and collect information on disclosure methods as well as allegations. And so the most common methods for disclosure include newspapers and TV, which is more than half. About 18% of the campaigns are from conferences, as well as 13% are from letters to investors. Now, this specific type of disclosure, conferences, we'll come back to. This potentially is a useful setting for us in that it allows us to argue that, well, maybe the timing of these campaigns is a bit more exogenous than those where the activist comes out and announces it on TV. And so this helps to mitigate some concerns related to confounding events for when we look at things like abnormal returns. And so our final sample that we'll be using in this paper consists of 252 public short campaigns by 51 different hedge funds. Here we're just plotting the time series of total campaigns. We see that the number of events is relatively low. Prior to 2008, we see that there's fewer than 10 per year. These jump up during the financial crisis and have remained at an elevated level since. And indeed, the year with the most number of campaigns in our sample is 2015, which is the final year which we currently have data for. Though, as I mentioned, we're updating this, and we hope to see how this trend has changed in recent years.
Ian, we've got a question from Vikas. He asks, what are the costs of active short selling? Your findings show significant benefits.
Our findings do show significant benefits. And so going back to sort of what I talked about in the beginning, some of the costs are just historically short sellers that disclose positions are vilified, but there could also be much more tangible costs in terms of facing litigation. And so you get to the examples of SAC actually being sued in court for libel, as well as investigations by regulators or other entities. And so the example I gave of David Einhorn and Allied, well, Einhorn was investigated by the SEC for what he did. And so I think based on historical precedent, the fact that we don't see many of these campaigns suggests that these costs play a real role in dictating what investors are doing. All right, so we see this overall upward trend in terms of the number of campaigns, the number of instances in which hedge funds are engaging in active short selling. Here we're just looking at some basic summary stats regarding the allegations. The most common allegation is just sort of a general overvaluation story. The hedge fund comes out and says, we think this stock is overvalued and we're shorting it. The other allegations include concerns related to the industry or the competitors of the firm. These are about a quarter of all campaigns. concerns related to the firm's product or business model, financials and capital structure. And then finally, we have about 13% of campaigns which make allegations related to fraud or other accounting issues. And then finally, just a few campaigns, just 11 in our sample, have a primary allegation related to either the management. Specifically, oftentimes, the hedge fund will bring up insider selling as the reason why they're short.
Ian, we've got another question from Bing Liang, who says, can the reputation effect be examined by comparing hedge funds with small firms like Muddy Water?
I think I would have to think about that. We haven't really thought about that in particular. I mean, I think you could easily argue that some of these smaller firms, like Muddy Waters, do have pretty reliable reputations, and it's certainly something that matters to them to the extent that this is a repeated game. And in fact, Muddy Waters' entire business model is based on the fact that people think they have a good reputation and will listen to their recommendations. And so I would think that the reputation effect is also strong when it comes to some of these smaller firms as well. Now, an area where I think there is an important difference is when we talk about some of these campaigns from Seeking Alpha, for example. And so Joshua Mitz has a paper talking about anonymous or pseudo-anonymous campaigns, where there's not a name or a real person necessarily attached to the accusations being made. And so there, well, the game isn't repeated necessarily. And so you would expect that reputation probably doesn't play as important of a role. But that's a good point. All right, so I apologize, this is a lot of information on one particular slide. I just wanted to look at some basic characteristics. What types of firms are targeted by these short selling campaigns? And from this table, we don't need to sweat the details, but one of the things that really comes out is that, well, one of the main characteristics that predicts a short selling campaign is firm size as measured by market value. And we see that there's a positive relationship between firm size and the likelihood of being targeted across all the different specifications we're looking here. We also see, if you look at the very bottom of the table, that short interest, so the existing short interest in a firm, also predicts these active short selling campaigns. And then there's evidence, perhaps a bit weaker, of some other factors also predicting the campaigns. For instance, we see some evidence in some of the specifications but not others, that Q as well as leverage can also have potentially some predictive power when it comes to active short selling. We can also look at the characteristics of the hedge funds that are engaging in active short selling. And so here we just come up with a bunch of different characteristics for each hedge fund that we can measure, things like the AUM, their portfolio returns and concentration. And here the thing that really sticks out in these regressions is the fact that activists are much more likely to engage in active short selling than other types of investors. And you see this, obviously we can't include this variable in the third column here when we have a fund fixed effect. The way we define an activist hedge fund is based on whether or not they've previously filed a 13D. But we see that this is a really strong predictor. And this is something that you would guess just from looking at the raw data, given that 80% of campaigns are undertaken by activist hedge funds. We also see some evidence, I'll note, and I'll come back to this a little later when we're thinking about the mechanism, that the AUM of a fund is positively related to the likelihood of engaging in active short selling, even conditional on whether or not you're an activist. All right, so those were sort of some of the sort of preliminary basic summary statistics for our sample. Now I want to start talking about the effects of active short selling. So first we think about, well, what are the effects of these campaigns on firm value? And so specifically, we'll be looking at CARs around the announcement of campaigns. And as I mentioned before, we'll also be analyzing the subset of campaigns announced at conferences to mitigate concerns related to confounding events. And so, for example, maybe we're worried about the fact that, well, the hedge fund chooses to announce a position on a day when other negative news is released. And so that would complicate our interpretation of these abnormal returns. And then on top of all of this, we're going to be comparing what we find to large changes in short interest. That is, we're going to be looking at, well, what are the CARs around a 5 percentage point change in short interest? And is there any incremental effect associated with this strategic communication via these active short selling campaigns? So here's what we find for our campaign CARs. And so the solid line here is the CARs for short campaigns. The dashed line are the CARs for large changes in short interest. And so for both of these, we see a very similar trend prior to either the announcement of a campaign or the large change in short interest, where CARs are trending up beforehand, or returns are trending up beforehand. However, upon the announcement of a short campaign, we see a sharp drop in returns. And so overall, the returns reach as low as -8%. Longer term, they seem to revert somewhat. But even if we expand this out and look even further, we see that the returns here don't fully revert. Now, if we compare this to what we see for the changes in short interest, well, we see that over a long period of time, there's also negative abnormal returns associated with these large changes in short interest. And this is broadly consistent with a number of papers arguing that shorts are broadly informed. But we see that the magnitude of this is much smaller than what we see for active short selling campaigns. In the paper, we test this formally, but it's probably not surprising just by eyeballing this figure that the abnormal returns here are statistically different. And we see much larger negative CARs around these short selling campaigns. As I mentioned a couple slides ago, here's where we look at conference announcement CARs to mitigate concerns about confounding events. And we see overall a similar magnitude of a drop upon the announcement for campaigns announced at conferences versus not announced at conferences. And so the lighter gray line here are those campaigns revealed at an investment conference. The darker line are those that are not revealed at a conference. Interestingly, we see a bit more of a run-up in these campaigns announced at conferences, seeming to suggest that, well, this position, to the extent that the hedge fund already had a position, was moving against them. And they decided to use a conference as a venue to publicly communicate with other investors.
Ian, we've got a couple of questions, and they're very much related. So Vikas asks, what is the evidence that accusations of active short sellers are indeed true? And then I'll go ahead and ask the follow-up as well, because it's pretty similar, which is from Christian Chu, who says, does the reversal suggest that at least some of the targets of the short selling campaigns are, in quotes, bogus? That is, short sellers that are credible insert an innocent target in their campaigns to drive its returns down for no reason other than that they shorted it.
These are great questions, and in fact, they're related to what we're doing now in terms of our revisions. And so, one thing that we want to do a better job at is sort of following the timeline of these campaigns and looking at, well, do they result in are they successful in some sense for the activist? That is, do we see firms taking some sort of action that would seem to indicate that the accusations being made from the hedge fund were true? This is a challenging thing to do. in a number of instances, and just anecdotally from looking at our data, oftentimes you'll see that the SEC or some sort of other regulatory body will investigate the accusations being made by the hedge fund. Often other times you'll see shareholders launching a lawsuit. In fact, that's something I'll be looking at showing you in a few slides. Now, this by itself doesn't necessarily indicate that the accusations made by the hedge fund were true. Many times when it comes to SEC investigations, for example, you'll see that the firm will engage in or agree to some sort of a settlement. They don't necessarily acknowledge wrongdoing. And so that's something we're thinking about now. We have RAs collecting data to track this better. Now, the idea that the cars revert to an extent, does that indicate that perhaps the accusations being made by the hedge fund were bogus? I think it's an interesting idea, and it gets to sort of a deeper point in some sense, which we've thought about. We don't think we can really say anything intelligent about. But the idea that, well, can you have a bear raid? That is, are there instances of campaigns here where the activists can actually get other short sellers to pile on, which we do see evidence of? But can this, in some sense, take a company below its fundamental value? That is not just incorporating new information, but actually, in some sense, destroying the company. People like to talk about this idea a lot. It's hard to say whether or not it's possible to measure this in our data. I think it's a really interesting idea, and we can think about that some more. So hopefully that helped to answer these questions. All right, so just to recap, what do we find with abnormal returns? We find evidence that the announcement of these campaigns is associated with quite large abnormal returns. And indeed, just to give you sort of a reference point here, the magnitudes we're talking about are comparable to what we see for activist, long activist campaigns, something around 7% or so. Next, we think about campaign or actions by other stakeholders. And so why do we do this? Well, to the extent that these short selling campaigns produce a credible signal, this may also affect behavior by other stakeholders. And so we're going to look at two things in particular here. First, do we see other short sellers shorting the stock? Second, do we see changes in litigation against the firm? Now, why do we look at these two particular stakeholders, short sellers and people who file litigation? Well, this comes back to the idea of what are these these hedge funds doing? And if you take a somewhat cynical view, and this is related to a point that I was just mentioning, which is, well, how could a short seller actually destroy value? These are two actions that they could take. And indeed, in Allied Capital, the example I talked about at the beginning of the presentation, they came out after Einhorn had announced his short position. They were obviously very critical of short sellers. And they said, well, if you're a short seller like David Einhorn, here's what you would want to do to hurt a company that you were targeting. And so this is the playbook of short sellers, according to Allied management. And they said that one of the key components of a short campaign is this idea of just manufacturing concern, creating a groundswell of concern amongst different stakeholders, short sellers, the SEC, research analysts, and so on. And two of the main points they made was, okay, if you're a short seller, you want to get a class action lawsuit. For instance, get shareholders to sue the managers. Second, they said you're going to want to convince other short sellers to also follow and pile onto the stock and pressure the stock price down. And so we're going to test, well, do we see any evidence that these two things follow the announcement of a short selling campaign?
Ian, we've got a couple of comments here.
Sure.
Vikas says that the reversal in the cars could also be related to firms responding to fix the problems pointed out by active short sellers. And then Christian follows up and says, in response to that comment, it may be worth looking at what firms say in response. The time horizon of the reversal is short, so it's likely that the problems are not fixed, but perhaps the firms are publicly committing to doing so. So just a couple of comments there that
I think those are both great points. I think hopefully when we finish collecting data on the outcomes of this, that'll provide us a way to better test some of these explanations. But I think those are both certainly valid reasons for what we might be seeing in the data. And so we will definitely think about that more. All right, so we're looking at the behavior here of litigation, of lawsuits, as well as other short sellers. First, we see evidence that short interest increases following the announcement of a short campaign. And so just to give you an understanding of what exactly we're doing here, we're going to be running our regressions within event here. And so we have firm I, event E, and time T. And so we're going to be including an event fixed effect here. And so essentially what we're doing is a simple difference comparison. That is looking at within event, do we see that short interest is higher following the announcement of a campaign than it was prior to that? And so overall, we find evidence consistent with this. The variable target, that's an indicator for when a firm is actually targeted. We see that's associated with about a 1 percentage point or 1.4 percentage point, depending on how the fixed effects you include, increase in short interest. And so the magnitude of this effect is fairly sizable relative to the sample mean for this short interest variable, which is about 8% in our sample. In fact, as I'll come back to later on in the talk, we see that this effect is even stronger for some of the campaigns in our sample, specifically those that make specific allegations. Okay, and so first we see that short interest is increasing following a campaign. We also see sizable effects on litigation. And so specifically in this specification, in this test, we're using a full panel here, firm by year. And the outcome variable we're looking at is an indicator for whether the firm faces litigation. And we use a very broad definition of litigation here. We include shareholder litigation, patent lawsuits, other types of regulatory enforcements related to fraud and accounting. And we see that, again, being targeted by an active short selling campaign is associated with an increase in the likelihood that a firm faces litigation. If we use sort of the full specification in column 4 here, we see that the magnitude of this effect is about 12 percentage points. And the effect, we don't report this in the paper, but we break down by different types of lawsuits. What's driving this here? And we specifically see that the results are driven by shareholder lawsuits, fraud and accounting lawsuits, and IP lawsuits. An additional thing I'll mention, these findings are robust to controlling for stock returns. One concern here might be that, well, there might just be a very mechanical relationship here. Oftentimes, shareholder lawsuits stem from the fact that the stock price dropped. That doesn't seem to entirely explain what we're seeing here, however. All right, so sort of the big question that we try to think about here is, why do we see hedge funds engaging in strategic communication? That is, what's the economic mechanism that explains what's going on here? And so we consider 3 main mechanisms. First, we're going to come back to this idea of limits to arbitrage. That is, does strategic communication help to overcome limits to arbitrage? And that's why we observe this behavior by hedge funds. A second point we're going to discuss is, well, do these campaigns by hedge funds constitute activism? As I told you before, well, the majority of hedge funds that undertake these campaigns are indeed activist hedge funds. That is, these are hedge funds who have filed a 13D for a long position in the past. Should we consider that this form of strategic communication, active short selling, is also a form of activism, and that's why we see activist hedge funds doing it? And third, we'll come back to the idea of reputation and credibility. Are our findings consistent with these models of strategic communication? We've considered alternative channels here as well. And in fact, this is something that would be helpful if anyone has any suggestions for other mechanisms we might want to explore here. In the paper, we consider things like hedging. We don't really find evidence consistent with this explanation for what we observe in the data. All right, so first, when it comes to limits to arbitrage, we want to think about, well, are the campaigns specifically a response to limits to arbitrage, like this paper by Lundquist and Chan talking about these small arbitrageurs? They argue that, well, public disclosure, these reports filed by firms like Muddy Waters, helps to overcome limits to arbitrage. Now, we don't think this is the primary explanation for the behavior of hedge funds that we see in this paper. And there's two reasons why we think this. Well, first, if limits to arbitrage are sort of the primary mechanism here, it's not necessarily clear why we would expect that the majority of campaigns, over 80%, like I said, are undertaken specifically by activist hedge funds. This sort of split between activist and non-activist hedge funds seems to suggest that this access to this activism technology that activist hedge funds have plays an important role in these short selling campaigns. Perhaps even more importantly, however, if you recall when we were looking at the predictive regressions, that is, what fund characteristics predict a short selling campaign. One finding there, one correlation in those tables was there's some evidence, and granted it was of marginal significance, that the likelihood of campaigns is positively correlated with the assets under management of a hedge fund. And so this seems to go directly against a limits to arbitrage argument, given that we would expect that these constraints are less binding for firms that have, or for investors that have more assets under management. And so overall, we think these two pieces of evidence sort of point to limits to arbitrage not being sort of the fundamental economic mechanism going on here. Next, we address this idea of activism. That is, do short campaigns constitute activism? And in fact, in many papers, both in the popular press as well as other working papers, they refer to this idea of short activism, which seems to suggest that, oh, well, these campaigns are a form of activism. However, we don't really think, generally speaking, these campaigns constitute a form of activism. Why is that? Well, let's compare a long activism campaign to a short activism campaign. In a long activism campaign, what does an activist do? Well, the activists buy shares and they pressure the board and managers to implement changes that will affect firm value, firm future cash flows. And they specifically use voting rights in order to accomplish this. What happens to in a short campaign? Well, in a short campaign, the activist seeks to enhance the flow of negative information into prices. That is, if the hedge fund argues that there's a problem with a firm's capital structure, they want the information about that problem to be reflected in the stock price. And so here it's more of an information story. And we don't think that this fits sort of the typical definition for activism. If it did, if indeed short campaigns did constitute a form of activism, well, that would suggest that, well, any type of activity that just tries to incorporate information into stock prices is also activism, which opens the door to sort of a wide range of behaviors. Things like analyst reports, for instance, being considered a form of activism, which we don't think is consistent with how the term is generally used. And so when it comes to this idea, well, is the reason why we see activist hedge funds engaging in so many of these campaigns, is it because, well, they're good at doing activism and short campaigns are a form of activism? Well, we don't think that that's a compelling explanation for what's going on here. And so finally, we turn to sort of our initial motivation in terms of coming back to these models of strategic communication, and specifically the role of investor reputation and the credibility of the message. And so specifically, papers that study strategic communication argue that these are sort of two of the fundamental ingredients that facilitate this. So first we think about reputation. Let me say this is another area where we're working to improve the paper. Right now, we're going to proxy for reputation using the number of activism campaigns undertaken, as well as the hostility of activism campaigns. Why do we think that these are proxies for reputation? Well, if you've undertaken a lot of activism campaigns, that would suggest that you're experienced, perhaps you're more skilled, which we think is a good proxy for reputation. I think hostility is also a good reputation in that if you're a hedge fund, if you're an activist, and you engage in hostile campaigns, what does that mean? Well, that means that you're doing things like launching a proxy fight. Well, to have any hope of winning a proxy fight when you own a relatively small stake in a firm, you need the support of other shareholders. To get that support, you likely need a strong reputation. And so right now we're going to be using these two measures to think about the reputation of hedge funds and activists in particular. But we're considering right now other potential ways to capture this idea. And so what do we do? Well, we're specifically going to analyze whether these proxies are related to the likelihood of undertaking a short campaign. All right, so in this table, the dependent variable, we're running these regressions simply at the fund level, the investor level. And so the outcome variable is an indicator for whether or not an activist is an active short seller. That is, whether we see that an activist hedge fund engages in public disclosure of a short position. In the first column, we see evidence that this is being an active short seller is positively correlated with the number of activism campaigns that an investor has undertaken. And so again, we're using this as a proxy for reputation. We also see that being an active short seller in column 2 is correlated with whether or not the activist has engaged in hostile campaigns in the past. And then we see that if we include both of these measures together in column 3, both are also positive and statistically significant. And so we broadly interpret this as being consistent with the idea that having a good reputation facilitates these active short selling campaigns. I'll also note in columns 4 and 5, we look at, we also include controls for an activist's success rate, failure rate, and settlement rate. And again, we're defining these using long campaigns. So is the likelihood that an investor is successful in their long campaigns correlated with being an active short seller? Well, here we don't see strong evidence of a relation here. And the likely reason for this is that, well, the activists who undertake ambitious campaigns, that engage in hostile campaigns, that try to get board seats, for example, well, overall, these campaigns tend to be less successful. And so this potentially explains why we don't see, given the endogeneity of things like success rates and failure rates to the actual tactics used by a hedge fund, potentially explains why we don't really see a relation here. And then I'll just note in the final column, the positive coefficients for number of campaigns and hostility remain significant, controlling for the success or failure of the activist as well. And then finally, we think about the credibility of the message, the second sort of key ingredient in models of strategic communication. And so to sort of motivate what we're doing here, an important idea is that the investment strategy of activist hedge funds likely differs from other hedge funds. And I'm not just talking about the tactics employed by the hedge funds or the investments that they make, but fundamentally, how an activist identifies stocks that they want to buy differs from other types of investors. And the key idea here is that activists specialize in finding problems. That is, suppose you're an activist hedge fund. You identify a problem with the firm. That is, you think, for instance, that the capital structure of a firm is suboptimal. Well, what can you do? Well, suppose that this problem is priced in a stock. And so the stock price reflects whatever the problem is with the firm. Well, the activist can go and communicate with managers of the firm and correct this problem, therefore increasing the stock price. And so, consistent with this general idea that activists specialize in finding problems, here's what David Einhorn says about the investment strategy at Greenlight Capital. He says that a typical process to identify opportunities is through computer screens that identify statistical cheapness, such as low multiples of earnings, sales, or book value, combined with rising earning estimates. Then they evaluate the identified companies as possible investments. And so that's sort of the typical process that we expect value investors do. But then he says Greenlight takes the opposite approach. We start by asking why a security is likely to be misvalued in the market. Once we have a theory, we analyze the security to determine if it is, in fact, cheap or overvalued. And so think about what he's saying there. He's saying that, well, Greenlight identifies a problem. If that problem is priced, well, and the stock is undervalued potentially, well, he can communicate with managers, try to get that problem fixed. But suppose that the stock is overvalued, the problem's not priced. That is, Greenlight discovers evidence that a company is engaging in fraud. Well, they have incentives to publicly communicate, potentially with other investors, and take a short position. So where are we going with this? Well, we hypothesize that activism experience, that is this access to activism technology, we call it, can enhance the effectiveness of active short selling and strategic communication because activist investors are really good at finding problems with firms. And so what are we going to do? Well, to sort of shed some light on this idea, we're specifically going to be analyzing outcomes, going back to all the outcomes we looked at earlier on in the paper, for campaigns that make a specific versus general allegation. And so remember, the campaigns with general allegations, that's where a hedge fund just comes out and says, well, we think that this stock is overvalued and we're shorting it, without giving sort of an exact reason for why they think it's overvalued. Specific allegations, well, these campaigns point to a particular problem with the target. That is, the hedge fund says, the company's engaging in fraud, and here's why we think that's true. And so here we're breaking down the abnormal returns for campaigns with general versus specific allegations. The light gray line here are cars for claims of general overvaluation. The black line are cars for specific allegations. And then again, just like we did before, we're including this dashed line that shows the cars for large changes in short interest. And so we see here that the aggregate effect we found regarding the negative CARs is driven by campaigns that make these specific allegations. We don't see a strong negative effect when the hedge fund just comes out and makes a general claim of overvaluation. And so here, sort of the takeaway is that, well, it appears that it's really these specific allegations driving abnormal returns, which suggests that, well, activists' ability to pinpoint these problems is an important economic mechanism. We can also look at the other outcomes related to stakeholder behavior. So specifically here, I'm running the same regression where the outcome is short interest. And so we're looking at short interest around the announcement of campaigns. And we see that in columns 1 and 2, we're looking at the general allegations. Columns 3 and 4, we're looking at specific allegations. Well, the change in short interest for general allegations is statistically indistinguishable from 0. Whereas for specific allegations, we see the effect is economically larger. It's about 70% larger than when we find for the full sample, and also statistically significant at the 1% level. And so again, just as it appears that, well, specific allegations have a bigger reaction or lead to a bigger reaction in stock prices, the same is true for the behavior of other short sellers.
Ian, we've got a question.
Sure.
Vikas asks, if CARs are so negative related to specific allegations, what is so special about hedge funds? Would one see a similar effect for other active short sellers? Should those be used as a benchmark?
Should they be used as a benchmark? I guess it depends on the exact sort of point you're trying to make. I think that I think specific allegations, well, their importance relative to general allegations, I think that general pattern would likely apply to different types of investors. I don't think that's necessarily unique to hedge funds. What we're highlighting with this is in terms of explaining the economic mechanism, in terms of why we see activist hedge funds doing this. What differentiates activist hedge funds from other hedge funds? We don't think that activist hedge funds are the only investor class, only type of investor potentially that specializes in identifying problems. We do think, however, that sort of highlighting this difference between activist hedge funds and other hedge funds helps to sort of shed light on the general economic mechanism that's driving our effects here. I guess what I'm trying to say is that, well, the fact that an important difference between activist hedge funds and other hedge funds is the fact that activists are good at identifying these particular problems, helps to lends credibility to this idea that the allegations and whether or not they're believable and these models of strategic communication sort of explains the results. To the extent that other market participants are also good at identifying problems, I think I would expect to see similar results. But that's something I think that's a fair point. That's something we can think about. I'll make a note to think about that a bit more. All right, and just in terms of this general breakdown between general and specific allegations, we also look at the litigation results. Do we see differences between campaigns that make a general versus specific claim? Here we're running a similar regression as I previously showed you for litigation. We have the full firm year panel, and then we include two different indicators in these regressions. An indicator for whether a target is targeted by a campaign with specific allegations or general allegations. And here we see again, well, the effect on litigation seems to be much stronger when a hedge fund makes specific allegations. The effect is, the coefficient here is economically larger. though the difference, if we statistically test the difference between these coefficients, it's somewhat marginal. But overall, the coefficient is larger. All right, how am I doing on time? Well, I'm pretty much done if there's any other questions, but let me just wrap up. So what are we doing in this paper? In this paper, we're investigating the emergence of public short selling campaigns by hedge funds. We find that these campaigns are associated with economically large negative CARs, as well as changes in the behavior of other stakeholders. Our results show that investor reputation and allegation credibility play an important role in this form of strategic communication. And we think that our findings highlight the difference between the transmission of positive information, where an investor will go out and buy a stock, versus negative information, where an investor will short a stock. And so thank you very much again for all your comments. And I'd be happy to take any other questions now if people have them.
Thanks, Ian. So I'll go ahead and leave the room open in case there are any other discussions. If you'd like to unmute your mic and ask Ian the questions directly, that'd be great. But thank you all for coming, and thank you to Ian for presenting.
Thank you.